Hi, everyone, and welcome to our webinar on volatility, the price of admission to long-term returns. Let's jump right in. Let's start by asking some questions. Specifically, what is volatility and what drives it? How do we measure volatility? We'll discuss time, diversification, and volatility. We'll ask the question, what matters more, timing the market or time in the market? And we'll finish off by reviewing some key conclusions. Risk in traditional terms is viewed as negative. Webster's dictionary, for instance, defines risk as exposing to danger or hazard. The Chinese symbols for risk, as seen here, give a more appropriate description to the word. The first symbol represents danger, while the second, opportunity, making risk really a mixture of the two. Most people confuse risk with volatility. And while contemplating risk, the main concern an investor has and demands compensation for isn't volatility, but the risk of permanent loss. So what is volatility? Technically, it's a measure of the frequency and severity of price movement in any given market. We know that it's an ever-present force in the stock market, but we also know that it shouldn't be the only factor considered when building portfolios, nor is it inherently negative. Volatility can come from lots of different places, but at its center, volatility is driven by changes in demand and the difference between expectation and reality. It can be introduced by new economic data, earnings reports and company changes, new innovations. It can be introduced by political changes, market sentiment swings, and geopolitical events. And the media and investors may attribute particular events to stock price changes, but the market is very complex and it's affected by a variety of different factors. When prices rise or fall, all that anyone can say is that the stock demand was stronger or weaker than the stock supply. How can we best measure volatility when discussing investment portfolios? The most widely accepted method by far is using standard deviation. From a technical standpoint, standard deviation measures how spread out a group of numbers are from the average. Let's take a look at the two charts below, both of which have the same average performance over time. The chart on the left, however, has higher standard deviation as seen by the higher and lower swings of returns. Roughly 2/3 of returns fall within plus or minus one standard deviation. But practically, what does that mean for investors? Well, if an investor has an investment that has average return of 5% with a standard deviation of 10%, that means most events will happen between -5% and +15%, 5% on average with that 10% standard deviation. And that's the technical assessment of volatility, but there's really an emotional component to volatility as well. Human beings tend to experience the pain of loss much more acutely than upside gains. And this is called risk aversion, and it can really impact decision-making. High volatility, especially when negative, can be very stressful and unnerving. Uncertainty can lead to fear, and it can cause investors to make short-term decisions that impact long-term outcomes. And higher volatility can impact cash flow requirements. However, volatility can represent a chance of better than expected returns. For long-term investors who are patient, volatility can help drive better outcomes. Let's take a look at a hypothetical example. Here's an investment made on December 31st, 2016. And let's assume that this investor made the purchase and then they went on a 5.5-year vacation without any access to the internet. They got back from their around the world trip and they wanted to check on their investment. And this is the return they experienced. However, for the investor who checked their portfolio on a daily basis, the ride was a bit bumpier, though with the same eventual outcome. Here we'll take a look at a longer-term time frame and a few longer-term investable assets, including large-cap U.S. stocks, international stocks, intermediate government bonds, and inflation as measured by U.S. CPI. The key finding here is that despite recurring periods of volatility, represented by the recessions shaded in gray, stocks have been the primary driver of returns, outperforming bonds and inflation by a really wide margin over long periods of time. You can't have a discussion about investments and volatility without including the VIX index. The VIX index, also known as the fear index, measures the implied volatility over the near term. It is an important index in the world of investments because it provides quantifiable measure of market risk and investor sentiment. And we can see here how it corresponds to market and geopolitical events, posting extreme highs in the Great Financial Crisis and again in March 2020 with the outbreak of the COVID pandemic. It's not necessarily the best trading tool, but it can show you when market capitulation has occurred and stress is starting to leave the system. But there is always going to be some amount of volatility and stress in the system. Here we take a look at the last 40 years of history, and we can identify that many years with positive returns overcame really large drawdowns. The red points represent the largest peak to trough market drop that happened in the year, while the blue bars indicate the total return for each calendar year. 2020 is a keen example of this, with its largest decline occurring in conjunction with the economic shutdown in March, but markets rallied over 50% from the bottom to finish the year at a positive 18% return. Losses truly are part of the territory, which always feels bad when you're going through it, but it's important to remember that we've been here before. In fact, drawdowns have happened more often than most recall. For instance, there tends to be drawdowns of 5% or more about 3 times a year, 10% or more around once a year, 15% or more about once every 3 years, and 20% or more, which is a technical bear market, occurs about once every 6 years. One thing to note is that the 20% drawdowns have become much more frequent recently, with 3 of them in 3.5 years, most recently in June 2022. When you start viewing returns and volatility over longer periods of time, the impact can get lessened quite a bit. Recall the chart earlier of our wayward traveler who didn't check their investments for over 5 years. Similarly, here we take a look at the experience for an S&P 500 investor with a 1-year time horizon. It's a really, really bumpy ride. But when you start to hold your portfolio for longer periods of time, you can really start to smooth out returns. Let's take a look at a similar story with more asset classes this time. Over the 1-year window, there's a massive spread of outcomes ranging from negative 37% to positive 53% in stocks. While a less volatile asset class on average, bonds similarly can have unexpected moves within range of negative 5% to positive 29%. But when you increase the holding period over 5, 10, and 20 years, you can see the range of outcomes tightens up considerably. This allows for better long-term expectations, cash flow planning, and peace of mind. It can be really difficult to time the market, which is to say to get the exact day to buy in or sell out of an investment. March 9th, 2009 was the bottom of the recession caused by the Great Financial Crisis. And if you were looking for an entry point to invest and you pulled up the Wall Street Journal for the day, you would have been greeted with these types of doomsday headlines: holding on for dear life, job cuts, dividend reductions. Emotionally, that was a really difficult time to consider buying stocks. Here's a more quantifiable way of looking at timing the market. If you bought the S&P 500 20 years ago, you would have annualized roughly 10% a year. If you missed only the 10 best days over that 20-year period, your return would have been cut nearly in half. If you missed the 20 best days, say the best day of each year, you would have achieved 1/3 of the return of the index. And most of these days follow the biggest drops in the markets. Market lows can result in emotional decision-making. So what are our conclusions? Volatility can be very noisy. The economy and financial markets are going through a normalization process, and economic and profit recession is likely. Volatility is volatile. The market's sifting through a number of uncertainties, and it could get worse before it gets better. But you don't want to abandon quality or secular winners. And it's really important to remember that no one can predict consistently when market declines will happen. No one can predict how long they'll last. And no one can consistently predict the right time to get in or out of the market. So what can we do? You should review your long-term plan, and you should always invest in a globally diversified portfolio. You want to be patient and think long-term. You want to avoid emotional biases. You want to disregard short-term market forecasts. Don't try and time the market. And remember that market corrections are opportunities. Thank you so much for your time and your interest, and please reach out to your team with any questions.